Louise Bedford here, your host of the Talking Trading podcast. I am bringing you this very special bonus episode by my business partner, Christopher Tate. Now, Chris Tate has done a complete market wrap. That's why I'm rushing it to you right now. He covers so many different topics, looking at the ASX 200, having a look at the commodity market, and working out what to buy this coming week. They are all areas of his expertise and things that he's going to cover in this podcast. So I hope you enjoy it as much as I did. I'll hand it over to Chris.
I'm Christopher Tate, and as you would expect, this is a chart-heavy presentation, so to get the best out of it, you'll need to head over to our YouTube channel and subscribe so you don't miss out on any of the content we generate. And these are some of the themes I want to be covering in this talk about markets for the week ending the 9th of February. I want to look at this notion of higher order themes, and I'll come back and explain what I mean by that in a little bit. I'll look at emerging markets in the US. I'll take a closer look at the S&P ASX 200, which of this week closed as a new all-time high. I'll look at the only commodity that I think is worth looking at for share traders and analogues they can generate for that. I'll then take a little bit of a stick to ETFs and their uselessness for trading some commodities, and then how we use analogues to find stocks to trade that represent an underlying commodity, and finish up with what I'm looking at buying on Monday, should conditions be conducive to that. Now, in terms of higher level themes, the thing to note here is that strategy matters more than tactics. Right market, right time, overall, beats right stock. And so we have to have some sort of mechanism for analysing and understanding what markets are moving and what markets present opportunities to us. And with that in mind, this is the S&P 500, the US index. You'll note there are two lines on this chart, one red, one blue. The red one denotes swings of 20% or more, and you can see quite clearly from this a series of very, very strong markets in the S&P 500. This is the nature of higher order thinking or higher level strategy, because this is a weekly chart, and it has been telling me that for the past 4 years at least, the S&P 500 in the US has been in a bull market. And we can particularly see the move from 2023 to this week, where the market has continued to generate new all-time highs. But there is one thing to note, markets are not linear. They don't generate all-time highs all the time. They do so pause, reflect, move on if there is sufficient interest. So we have to be aware of this. So in terms of higher order thinking, what does this mean? Well, it means, for example, that the US market has been the power market for probably more than the past decade, which means if you were looking for investment grade opportunities, not special situations, and I'll talk about those in a moment, this would have been the market to be involved in. But in addition to that, this would have been the market to be involved in if you were an index trader, either directly or an index trader via an ETF. The performance of ETFs over US indices outpaces that of ETFs over our local indices. So if you're an investment grade style of manager and you use ETFs exclusively, your focus would have been on the US market, not the domestic market. You would have bought SPY as opposed to STW. That's just the way the world works. And in terms of taking a closer look at US indices and comparing and contrasting, on this little tableau we have the Dow Jones, the S&P 500, the Nasdaq 100, which has been the power performer, and the Russell 2000. The Russell 2000 is representative of the broader US market, And I've included it for the simple reason that when we blow the chart up and look at it on a daily time frame, we see an interesting pattern forming. If we go back to our little comparative table, we can see that whereas the other indices have been moving up quite strongly, the Russell 2000 has gone sideways for some time. The smaller cap market in the US has been quite lackluster and has not really moved along at all. And so the point to make from it, particularly the S&P 500 and the NASDAQ 100, is that they've been driven along by a handful of stocks known as Magnificent Seven. These are technology stocks, and they've done most of the heavy lifting for, let's say, the past 15 months. The Russell 2000 has been drifting, and this drift all of a sudden presents us with an opportunity, and you can see the pattern I've highlighted in recent weeks. We have the market running into a little bit of resistance, slightly above where it closed on Friday. But more importantly, we've got the market making higher lows, and these are rejection higher lows. So this is setting itself up, should the market break through resistance, to offer potential to participate in this index. And in terms of participation, there are multiple ETFs that cover the Russell 2000. They also drill down a little bit further and look at micro caps within this market segment. And it is there that I would be looking should the Russell continue to move forward and break out. Of course, if it falls away from resistance, all bets are off. We reset, reevaluate. In terms of the local market, the local market is always interesting because being a small market that does suffer from relative liquidity problems compared to other markets, it behaves in an interesting manner. And you can see that on Friday, the market barely closed above this long-term channel we had. And this is a weekly chart, so we can see the drift up in towards COVID, the fall away from COVID, the recovery, and this sideways movement we've been stuck in for 2 years, 3 years now. And so we have barely moved above this resistance. And if we drill down a little bit, we can see this sort of very lackluster attempt to break through. We had an initial break early in the week. Prices then fell away. They then began to drift. And this drift is problematic. For this to generate any sort of excitement in me, you would need to see a very, very clean, clear weekly break. But I want to take a step back and look at a structural element within our market that might go some way to explaining why our market is so lackluster. Here I'm comparing and contrasting the cumulative new 52-week high lows for the All Ordinaries on the top part of this chart and the S&P 200, the ASX S&P 200 on the bottom. And you can see they look similar, but when we look a little bit closer, they are different. And I want to concentrate on the extreme right-hand part of the chart and compare that to the last true bull market we had. Our market is bullish, but despite what people are saying, it is not a bull market, not by any stretch of the imagination. A bull market is characterized by the sort of move we had 2003, 2007, where we had a widespread number of stocks moving to new 52-week highs. The market was just strong, and it was strong across all strata of the market. It wasn't just strong in a selected index. And this is the problem with the Australian market. There is so much churn in the ASX 200 that it is often difficult to get a true picture of what is happening. Yes, the index might be going up, and that's very good if you're an index trader. But what does that mean for portfolio traders who may or may not be holding stocks within the index? An index can go up because of its structure without the vast majority of stocks within that index going up. This is the way indices are constructed. They're weighted, and they're weighted according to size. So larger stocks have a disproportionate impact upon the index itself. And it's quite possible for a handful of stocks to go up, push the index up, but for the vast majority of stocks to go nowhere. And so from my perspective, for me to consider this to be a bull market, I actually need all strata of the market to be making new 52-week highs, to be pushing ahead so that we have this broad base of support. And this leads me to a tactical point. I rarely trade the S&P ASX 200 index itself. And I rarely trade it simply because it doesn't trend very well. And so for an index trader, there are better opportunities within my portfolio than this index itself. Yes, there are some circumstances under which I will trade it, but they are quite uncommon. And there are a lot of hurdles for the market to get over before I consider such a trade. And as an extension of that, I almost never trade stocks inside the 200 itself. My stock trading is well outside the ASX 200, and that is because I look for a different sort of stock. And as I've spoken before in other videos, buying heavyweights will not get you wealthy in the domestic market. It just won't. There is only one heavyweight which over various years has had exemplary performance, and that's CSL, and its performance seems to be in the past. So if you're buying heavyweight stocks expecting them to go up by 50%, double, triple, you're wasting your time. The Australian market is a special situations market, as evidenced by the lithium boom 2 years ago and the uranium boom of last year. So we need to be strategic in the way in which we make our decisions. We come back to this notion that strategy beats tactics. So in terms of converting strategy into tactics, this is an observation of the energy complex from last week. And we have gasoline, crude, heating oil, and I've thrown in natural gas for contrast. The first point I want to make is that commodity markets trend. When they do trend, they trend quite strongly. And we need to be aware of that, and so we need to understand how we take advantage of that and how we participate. Traders are often scared off from dealing in commodity markets because they believe them to be intimidating, to be somewhat mysterious and beyond their ability to effectively deal in them. I'll point out somewhat bluntly, that's nonsense. If I were to take the name away from these instruments and you were to just look at the chart, you would not know what they were. And so all we're attempting to do is trade price. Remove the name and trade the price. And I've thrown in natural gas because its trend in 2023 was so extreme, and then it went sideways. So we get an understanding of how extreme these moves can be. Also, of the four, three threw an interesting little pop last week. Gasoline, heating oil and crude popped last week. And if we take a closer look at crude, we see this notion of higher lows, but we also see resistance at around the $80 mark. Many people take the wrong view of resistance and view it negatively. I view it positively simply because it gives me a fixed and firm landmark. It gives me a very, very firm trigger that if price moves beyond, I'm being told something very important. And we come back to this notion that markets will tell you everything you need to know. You just have to listen and remove yourself from the decision-making process. So my view of crude is that 80 is the nexus point for us. If we get a move above 80, not only is that positive for the underlying commodity, that is positive for any instrument that might be associated with crude. And this brings us to the tactical notion of how do you make a decision as to what to trade. Well, the first step that people generally default to if they're not trading the underlying commodity, and I recommend that you learn how to do so if you don't already know, is to default to an ETF, an exchange-traded fund that represents the price of the commodity. But there are problems with some ETFs and the way they go about participating in these underlying markets. This is a chart of Beta Oil, which is a locally listed ETF that covers oil. And it looks like any other chart. It sort of meanders around, goes up, goes down, has gaps, and has sideways movements. But there is a problem with the structure of these sorts of ETFs. They don't adequately reflect the performance of the underlying commodity. And here I've overlaid the price of crude with this particular ETF, and you can see a marked underperformance. And that underperformance is problematic. And that brings me to a strategic rule that reflects this tactical reality. And that is that commodity ETFs that gain their exposure via futures contracts are suboptimal instruments or trading. Avoid them if you can. If you have no other alternative, no other option, then you may consider them. But they are suboptimal in their reflection of any opportunity that might present itself in the underlying commodity. And the reason for this is structural. And I've taken this from Beta Oil's site itself, and I've highlighted a few points. The first one is the price of oil futures contracts is not the same as the spot price of oil. And that's true, that's a given. But that's not necessarily the problem. The problem with these ETFs is highlighted in the very last phrase that I've noted. And it says the prices of futures contracts for subsequent periods are known as the futures curve. That's not very well explained. When you trade futures, you will buy a given month. And let's assume that contract goes up, but that contract has an expiry period. And at the expiry date, you will need to sell it and buy the next one. So if futures prices are trending up, then you will sell one for a given price, but you'll have to buy the next one, for a higher price. This reflection of higher prices is known as contango. What it means for people who do this is that each time you move to a new contract, you pay a higher and higher price. So this is not like buying a stock at $1 and holding it at $5. This is like buying a stock at $1, selling at $1.50, having to buy it back at $1.65, selling the one you bought at $1.65 at $2, having to buy it back at $2.15. Each time there's a clip coming out of what you could have potentially made. This is problematic, and it is the reason why we see this underperformance in ETFs that do this. It's always intrigued me that ETFs actually do that, because these are oil futures prices out to December 2024. And the column to be interested in is volume. You can get set out to December 2024 quite easily. You could get set out to December 2024 in the oil futures options market. And given that I'm recording this in the beginning of the second week of February, that gives you an awful lot of time to get set and sit and not have to worry about rolling. So that's a structural issue. This raises the tactical point of, well, if I'm not going to trade the underlying commodity, how do I get exposure to this? And the mechanism for doing so is to look at analogues. Analogues are stocks that have broad exposure to a commodity. The problem we have here in Australia, and it's a problem everywhere, is that it's difficult to find a pure oil play. They tend to be mixed use vehicles, so they're oil and gas. You don't get pure exposure, so the waters are a little bit muddier than they otherwise could be. And this is also a little bit problematic from a functional aspect in that back in the good old days, before we adopted the S&P system of GICS allocation of sectors, we used to have an index called oil and gas. So it was quite easy to look through that and spot oil stocks. Now we have these very broad-based energy sectors, which makes it a little bit more problematic. So this raises the question of how do we gain exposure to an underlying commodity if we're not trading the contract itself? The ETFs are suboptimal. Well, the mechanism we use is analogues. We look for something that has exposure to the underlying. That is sometimes a little bit difficult because here in Australia, energy stocks are effectively a mixed use bag, so they're oil and gas. They're not separated into oil only. And from a broader view of the industry, that's understandable. But just as an example, what I've shown here is, this is VEA, Viva. Viva is an energy supplier. They own a refinery here in Geelong. They sell Shell products. And I've compared it to the price of our domestically listed oil ETF, and you can see the outperformance of the analogue. And this is traditional for these sorts of comparisons. Analogues outperform these sorts of ETFs, so you would be looking for an analogue. This raises the question of how do we do this from a tactical perspective. So we've got this notion of this broad view that oil may or may not present us with an opportunity. How do we prepare ourselves for that? This particular listing of stocks comes from marketindex.com.au. They very kindly, or to the best of their abilities, put together a list of commodity stocks, and they assign them to their various broad underlying commodity. So these are ASX oil companies, but you'll see they're mixed use. BHP, Woodside, Santos, they're mixed use, they're oil and gas. And I have ranked these by market cap, just so we get a sense of the size of many of them. If I were trying to build some form of workflow that would enable me to take advantage of a change in a commodity price, I would look at the commodity. I would then look at a site like this and have a look at this sort of watch list. And you can see it enables you to rank according to a variety of metrics. So you can rank according to price, change in price percentage, price change. You can also alter it according to their 1 year price change. So this would be your second port of call. Having looked at the commodity, you would then come here. It would be best to assemble this sort of watch list in advance so you can instantly chart these or instantly scan them for opportunities. There is a little bit of a problem with people whose workflow does not reflect that sort of logic. So what they'll do is they get a notion that something like oil is moving, and then they'll come here and try and make a decision on the fly without any form of further analysis. That's problematic. But the point I would suggest you do is that if you have a list like this, it does need to be ranked by some degree by market cap. When I generated this particular ranking, I actually reversed the rankings and looked at the lowest market caps. The lowest market caps for a very, very large number of these stocks would not buy you a 2-bedroom unit here in Melbourne. So this is a market that is very diverse in terms of size. There is a lot of junk in it, which is why you have to prepare in advance. we can even see here that once we drop outside the top 10, the top 15, market cap drops off precipitously. If we were to look at something like Pan-Continental, PCL, a market cap of $177 million is not much. This presents another problem with this segment of the market. You will need a liquidity filter that you set in advance so that you're not caught in very illiquid stocks. So the process would be, in summary, spot the commodity, already have these lists established, and a site like Market Index will enable you to do so because they've done most of the heavy lifting. It's then up for you to translate that into whatever package or program you use. But this process just becomes so much easier if you learn to trade the underlying commodity, which you can do quite easily now with CFDs. You do not have to go through the difficulties of setting up and becoming familiar with some of the minor and modest idiosyncratic nature of futures trading. So in terms of what I am looking to next week, and I only have one thing on my agenda for next week, and it comes back to this notion of learning to trade underlying commodities. This is New York cotton. And so my view for next week is that if I get this is the CFD, if I get a close above the line I've marked here on the chart, then I'm a buyer. But this comes to another point, and we're coming back to this notion of higher level or strategic thinking. This is already prepared for the Monday trading session of this particular commodity. This is not being made up on the fly. So all this analysis is done in advance, and the instruments and tactics that I will use are not something that you simply just jump at. There is a set workflow that precedes every trading period. And if there is one point that you need to take away from this brief look at markets, it is that this all needs to be set in advance. You'll note if we go back to my original chart, which is a chart of the S&P 500, it's a weekly chart. It's not a daily chart. It's not a 4-hourly chart. It's not a daily chart. It is a weekly chart because I want to get a sense of what the broad picture is before moving any further into this decision matrix that I have. So when you come to trade for whatever you might trade for the next week, make certain that you have some sort of predetermined decision-making matrix in place, and you're not just simply making things up as you go along.
Well, I hope you are feeling as inspired as I am. Tune in just a couple of days because we are going to give you Alan Hull in all of his glory in an interview that I conducted with Alan that I know you are going to love. He's talking about the importance of wellness and what you can do as a trader to recover more quickly so that you can keep on fighting the good fight in the markets. Until then, happy trading.